Welcome to the Wealth Continuum, where we decode the patterns that shape generational wealth. I'm your host, and today we're analyzing a seismic shift in global finance that most investors are completely missing. While financial media focuses on daily stock movements and Federal Reserve statements, the real story is unfolding in the most boring document in finance, the US Treasury International Capital Report. The data released this week reveals something extraordinary. China has liquidated its US Treasury holdings down to $688 billion, the lowest level since May 2009. To put this in perspective, China has dumped nearly 48% of their position from the peak, selling over $600 billion in American debt. But it's not just the amount that matters. It's the timing, the speed, and what they're buying instead that tells us where this is heading. Let's establish the baseline. In 2013, during the peak of what economists called Chimerica, the symbiotic relationship between China and America, Beijing held $1.32 trillion in U.S. debt. They were the factory, we were the consumer, and Treasury bonds were the glue that held the system together. China earned dollars by selling us goods. They recycled those dollars by buying our government bonds. This kept interest rates low, allowed Americans to keep buying Chinese products, and created a closed loop of capital flow. It was the foundation of the global financial order for 2 decades. That loop is now broken. But here's what makes this different from a normal portfolio rebalancing: the market context. Throughout late 2024 and into 2025, the U.S. bond market experienced a historic drawdown. Interest rates were volatile, and bond prices, which move inversely to yields, were depressed. Anyone selling U.S. Treasuries during this window was selling at a realized loss. In asset management, you do not sell a depreciated asset for a loss unless one of 2 things is true. Either you are facing a liquidity crisis and desperately need cash, or you believe the asset is about to become toxic. We know China isn't facing a liquidity crisis. Despite their domestic real estate challenges, they continue running a massive trade surplus. They're swimming in cash. So the only logical conclusion is that the Chinese Communist Party has made a strategic decision. U.S. Treasury bonds are no longer a store of value. They view them as a strategic liability. This is the sanction evasion signal. Remember February 2022. Russia invaded Ukraine, and overnight, the United States and European Union froze $300 billion of Russian central bank reserves. Funds sitting in Western accounts in New York, London, and Brussels were immobilized with a few keystrokes. Beijing watched this carefully. They ran the scenarios. If tensions escalate over Taiwan, if the South China Sea conflict goes hot, their U.S. Treasury holdings aren't an asset. They're a hostage waiting to be seized. The $688 billion they still hold could go to zero the moment sanctions are applied. So they're liquidating with extreme prejudice, willing to take a 10-20% haircut on the bonds today rather than risk a 100% loss tomorrow. Now here's where it gets interesting. When the second largest holder of your sovereign debt dumps hundreds of billions onto the market, basic economics says prices should crash and interest rates should skyrocket. But that hasn't happened yet. Why? Because as China exits, the allies are being forced to step in. Look at the data closely. While China's holdings plummet towards $600 billion, other line items are spiking to historically abnormal levels. Specifically, the United Kingdom and Belgium. The UK's holdings have surged to over $750 billion in late 2025, making them neck and neck with China as the second largest foreign creditor after Japan. Think about that. The UK economy is roughly 1/6 the size of China's. Britain doesn't run a massive trade surplus. In fact, they run a deficit. So where is Britain getting the money to buy nearly $750 billion in U.S. debt? They're not buying it with excess profits like China did. They're leveraging their own balance sheet, using borrowed money and financial engineering in the City of London to act as a shock absorber for the U.S. Treasury market. Then there's Belgium, with holdings around 320 to 370 billion. Belgium isn't suddenly flush with cash. Belgium is home to Euroclear, one of the world's largest international securities depositories. When you see Belgium buying U.S. debt, it's rarely the Belgian government. It's usually a proxy for other central banks and sovereign wealth funds trying to mask their activity. The surge in UK and Belgian holdings, occurring exactly as China sells, suggests a coordinated effort by G7 nations. This is what I call the bagholder alliance. This isn't a free market decision. Washington is effectively telling its partners, China is dumping. If you don't step in and absorb this supply, the U.S. bond market breaks. If the U.S. bond market breaks, the global financial system breaks, and we can't protect you. It's financial conscription. The West is cannibalizing its own balance sheets to absorb the supply coming out of Beijing, but this strategy has a fatal flaw: capacity. China had seemingly infinite capacity to buy debt because they were the factory of the world, earning real dollars by selling real goods. The UK and Europe don't have that capacity. They're already struggling with their own debt burdens and slow growth. By forcing them to buy US Treasuries, Washington is draining liquidity from its own allies, weakening the periphery to save the core. And China knows this. They're playing a game of attrition, bleeding the West dry $1 billion at a time. So China is selling bonds. What are they doing with the proceeds of this $600 billion plus exit? They're not buying euros or yen. They're engaging in the most aggressive commodity accumulation drive in modern history. They're converting paper claims into physical reality. First, gold. The People's Bank of China has been a relentless buyer of gold for 18 plus consecutive months officially. Unofficially, Shanghai Gold Exchange withdrawals suggest the buying is much larger. Gold is the ultimate anti-dollar. It has no counterparty risk and cannot be frozen by the SWIFT system. By swapping U.S. debt for gold, China is moving from credit-based reserves to collateral-based reserves. Second, energy. China imports 70% of its oil. This is their strategic Achilles heel. In a conflict, the U.S. Navy could blockade the Strait of Malacca and starve their economy of energy. To counter this, China has been buying record amounts of oil, often from sanctioned nations like Iran and Russia, paying in yuan and bypassing the dollar entirely. Recent data indicates China's crude stockpiles are nearing 1.5 billion barrels of combined commercial and strategic capacity. Satellite imagery shows construction of massive new storage farms and underground caverns. They're building a buffer that would allow them to survive a naval blockade for months, perhaps years. Third, strategic metals. Here's the most telling signal. China's property sector, historically the biggest consumer of copper, is in a depression. Real estate construction is down. Yet China's imports of copper ore remain near all-time highs, roughly 28 million tons in 2024. This defies standard economic logic. If you're not building apartments, why do you need so much copper? Because you're shifting to a different kind of economy. You need copper for the green energy grid to reduce reliance on imported oil. You need copper for munitions, drones, and electric vehicles. China is cornering the market on the physical inputs of a 21st century industrial complex. They're also hoarding cobalt, lithium, and rare earths. While the U.S. financializes its economy, China is materializing its savings. Fourth, food security. China produces 20% of the world's GDP, but has only 7% of the world's arable land. According to the USDA, China holds approximately 60 to 70% of global reserves of corn and wheat. They have enough grain stockpiled to feed their population for over a year without a single import. This is the fundamental shift. A nation planning to remain at peace keeps its wealth in efficient, interest-bearing financial instruments like US Treasuries, chasing the highest return on investment. A nation preparing for conflict converts its wealth into inefficient physical stockpiles. Holding 500 million tons of copper pays no interest. In fact, it costs money to store. It has a negative yield, but it has a massive return on survival. China is willingly accepting a lower financial return today to ensure they cannot be strangled tomorrow. This explains the loss they're taking on the bonds. Beijing doesn't care about a mark-to-market loss in fiat currency terms. They care about resource security. If they sell a bond at a loss, but use the proceeds to buy oil they'll desperately need if shipping lanes close, that's a winning trade. They're trading fake wealth that can be frozen or inflated away for real wealth that can be burned in an engine or used in manufacturing. Let's bring this back to your portfolio. For 40 years, the 60-40 portfolio, 60% stocks, 40% bonds, was the gold standard of investing. Bonds were the safe haven, the ballast that kept the ship steady. That era is over. The US Treasury bond is no longer a risk-free asset. It's a political football in a global economic war. It's an asset class that relies on the kindness of strangers who are increasingly becoming adversaries. If China, the ultimate insider of the global manufacturing world, is getting out, you need to ask yourself, why are you staying in? Here's how you position yourself for a world where the biggest buyer has left the market. Strategy 1. Shorten your duration. If you hold bonds, understand duration risk. Long-term bonds, 20-year, 30-year treasuries, have high duration. If interest rates rise by 1%, the price of a 30-year bond can crash by 20%. As China exits, the structural pressure on long-term rates is upward. Even if the Fed cuts short-term rates, the long end of the curve, which is determined by supply and demand, not the Fed, is vulnerable to a buyer strike. If China sells and the UK taps out, yields must rise to attract new buyers. Rising yields mean crashing prices for existing bondholders. Do not hold long-term US government bonds or ETFs like TLT. These are the assets most vulnerable to the Chinese sell-off. If you want safety and yield, keep your cash in short-term treasury bills, 1 month to 6 months. Short-term bills have almost zero duration risk and act as cash equivalents. Be like China, get liquid, get short-term. Don't lock your money up for 30 years with a government fighting an economic war. Strategy 2. Follow the smart money into commodities. China is selling paper to buy stuff. You should consider doing the same. Your portfolio needs exposure to energy, metals, and real assets. This isn't just about profit, it's about inflation protection. Think about the end game. If China dumps their remaining holdings and the Allies eventually stop buying, who buys the debt? The Federal Reserve. The Fed will have to step in as the buyer of last resort through yield curve control. They'll print trillions of dollars to monetize the debt. When they print trillions, the value of the dollar falls and the price of stuff goes up. This is the inflationary loop, and China knows it. That's why they're buying the stuff now. You should own the producers of these assets. If China is hoarding copper, own the miners that produce it, companies like Freeport-McMoRan. If China is hoarding oil, own the energy producers like ExxonMobil or Chevron. If China is hoarding gold, own the metal itself. These assets hedge against currency debasement. Own the stuff, not the currency that buys the stuff. Strategy 3. Watch the warning signals. You need to know when the bag holder alliance is breaking. Monitor the currencies of key US allies, specifically the British pound and the Japanese yen. Japan is the largest holder of US debt, but they're fighting their own currency crisis. The yen has been volatile. If Japan has to intervene to save the yen, they'll have to sell US Treasuries to get cash to buy their own currency. If Japan joins China in selling, it's game over for low rates. Watch the USD JPY exchange rate. If the yen crashes toward 160 or 170, or if Japanese bond yields spike, it means the alliance is fracturing. That's the moment the Federal Reserve will be forced to intervene, not because inflation is beaten, but because the Treasury market is broken. The $688 billion figure isn't just a statistic in a government report. It's a signal. China is methodically, deliberately removing itself from the U.S. financial system. They're clearing the decks, willing to take a loss today to ensure survival tomorrow. Do not interpret the current stability of the market as safety. It's an artificial stability propped up by political pressure and borrowed money. When that prop gives way, the adjustment will be severe. The patterns are clear when you know where to look. China is exiting financial claims. The Allies are absorbing the flow with borrowed money. The proceeds are being funneled into hard assets that survive disruption. The global reserve system is shrinking from a worldwide market to a NATO-only market. This is the financial architecture of a world preparing for fundamental change. Your move on the wealth continuum is simple. Get out of long-term debt, get into hard assets, and watch the flows. The divorce papers have been filed. We're just waiting to see who gets the house. This has been the wealth continuum. If this analysis helped you see the patterns others are missing, subscribe and share this with someone who needs to understand what's really happening with their wealth. The continuum of wealth across generations depends on seeing these shifts before they become headlines. Until next time, protect your wealth, understand the system, and stay ahead of the curve.